This section, business bad debts and business casualty losses. Now, it's rare to actually have a bad debt, a business bad debt on a Schedule C, because remember, we're using the cash basis of accounting. A bad debt means that you have recorded the income at some point, but you never received it. Well, on a cash basis, that's never going to happen, because we're only going to record income when we actually receive it, right? So it's a very rare instance when we would have a business bad debt on a Schedule C type of business. Now, when we get to corporations, you'll see that corporations don't always account for on their tax return on a cash basis. They will use the accrual basis for corporations. But for sole proprietorships, we don't. We work on a cash basis. So, but in order for, let's see, if the debt is considered a bona fide business bad debt, it must have been ordinary, necessary, and reasonable in the trade or business. So you can also claim a bad debt on a personal, like if you lent somebody money and you wrote out a note to them, say you lent your brother $5,000 so that he could, I don't know, buy a car or something, and you wrote out a note indicating that he signed as well, that this loan is a valid loan, and then he doesn't pay you back, you actually do get to claim that as a deduction, a personal on your personal tax return. Certain requirements have to be met for that. A non-business bad debt would be treated as a short-term capital loss. We're going to talk about those in the next chapter, by the way. And it's only deducted when it becomes completely worthless, so there's absolutely no chance of collecting on it. Business bad debts can be deducted when they're either partially worthless or completely worthless. They're treated as an ordinary deduction. Now, like I said, it's pretty rare to see this on a sole proprietorship because we don't claim the income. Like you don't claim it as income until you actually receive the cash. And they've got an example of that. We've got Mateo, cash basis sole proprietor, gave advice to a corporate client and he billed them $700. The corporate client went out of business, I guess it was bad advice, went out of business and filed for bankruptcy and never paid Mateo. Because that Mateo never included in income that $700 because he never received it, it's not a bad debt. So he doesn't take a bad debt deduction. The only time you'd take it is if you had claimed it in income and you had paid tax on it. So, or the other option is you actually are out the money. So I think there's this example here, Mateo, in addition to the $700 that he billed, he lent the company $500. All right, well now he's actually out some cash. He lent them $500 and they didn't pay him back for that. I'm sorry, $5,000, and he didn't pay him back. They didn't pay him back for that $5,000. In that case, he can claim an ordinary deduction for the $5,000 that he lent out. Now, Mateo's obviously not a very good business person because he's not collecting what the clients owe him and he's lending out money to his clients and then they're not paying him back. But in this case, because he actually is out the cash, then he can take a business bad debt. So that's the difference. If it was income that was foregone, he would not get to claim the business bad debt because he never claimed the income as taxable income in the first place. But that $5,000, because he lent it out, the actual cash, at some point he did claim that as income, right? Because he got it somehow. I mean, maybe he took a loan out for it, but even then he's going to have to pay that loan back. So he's $5,000 economically. It creates a deficit for him of $5,000 because he's out that money. If a bad debt is deducted, any recovery of that bad debt in subsequent years would be included in gross income. So let's just say Mateo took the $5,000 bad debt expense in 2025, but then in 2026, the company actually sends him $1,000. Well, now he's going to have to claim income of $1,000 because he had claimed the full $5,000 as a deduction in a prior year. Business casualty losses, these are different from the personal casualty losses. Remember in the last chapter, we talked about personal casualty losses where it has to be in a presidentially declared disaster area. You don't, that for business casualty losses, you don't have that requirement. So when business property is lost in a firestorm, shipwreck, theft, or other casualty, the taxpayer will normally receive an ordinary loss deduction for the basis of the property, unless the property is only partially destroyed, with the partial loss is the lower of the decrease in fair market value. So the amount of the loss that actually happened. So the decrease in fair market value before and after the casualty, or otherwise known as the adjusted basis. So whatever it's worth after the casualty. And if insurance proceeds are received, then that offsets that business casualty loss. So let's see, 4684, a 4684 is where the business casualty losses are listed. So here we've got, this is what that form looks like. Let's look at this example. We've got Dwayne. Dwayne's office building was destroyed by a tornado on September 17, 2024. He had purchased the building in 1987 for $90,000, but he had recently made improvements to it. So the adjusted basis, which is his cost less the accumulated depreciation that he had taken, and the fair market value at the time of the tornado were $80,000 and $110,000 respectively. So the adjusted basis was $80,000. $110,000 was the fair market value right before the tornado struck. So his loss was the difference between those two, right? $30,000 respectively. So he had not updated his insurance policy in several years. He only received $70,000 from the insurance company. So the $70,000 that he received was essentially to pay for the basis there of $80,000. But like they said, he hadn't updated his insurance policy, so it wasn't updated for the new fair market value of the property. Because the building was totally destroyed, the business casualty is $10,000, which is calculated by taking the adjusted basis of $80,000 minus the $70,000 insurance reimbursement. So the $10,000 is listed here on Form 4684, and then it eventually shows up on the Schedule C. So this is what it would look like. So all of that whole calculation is done here. Cost or the adjusted basis of the property minus insurance proceeds that were received. Fair market value before the casualty, so it was worth $110,000. Enter the smaller of this line or this line, so smaller of 20 or 25, 80,000. Subtract line 21 from line 26, so line 21 is 70,000. Line 26 is 80,000. The amount of the deduction that he gets is $10,000, which also then gets entered here. I don't know that you may have some homework problems that involve the calculation of a business casualty loss, but you do not have to fill out this form on the tax return problem, okay? Whoops. So that's the business casualty losses. Any questions about the business casualty losses or the bad debt expense?